Today should be fun because one of our panelists is joining us remotely. So just being able to continue to try out the new technology as we go deeper and deeper into it. But welcome everyone. Oh my goodness, it's so good to see so many faces in person, and welcome to all of you online too. Should I be looking at that camera to see all of you? Yeah, keep in touch with us in the chat box. Feel free to put any questions in there as we go along the program, because we'll have some time at the end for Q&A. But yeah, so I'm a principal at Transwestern. We just came back into the office, moved in a brand new space just a week or two ago, and are back in full swing. I'm curious, just by show of hands, how many of you are working primarily from the office, even in just like a hybrid type form? Okay, so yeah, like 2/3, 3/4. Online, go ahead and put in the chat box, like how if you're back in the office. And okay, so keep your hands up. If you're not already back, are you planning on coming back in like January and being back in full swing? Okay, so for the most part, the 3/4 of the people in the room are back, and that's who's going to be back in kind of full time. That is in line with industry standard for us. It definitely outpaces across all industries. Who, you know, as we know, downtown is still 20 to 30% occupied in most buildings. But I think we're trendsetters, and we're gonna lead them all back. But what a whirlwind these past 18 months have been, right? We have dealt with multiple waves of COVID, mandatory lockdown, civil unrest, and one of the most historic elections in Minneapolis history. Whew, glad that's past us. But we all took a pause this past year as as the office market was one of the industries most impacted by these events. So as we return to the office, we're seeing some areas have fared better than others, but that's perception versus reality, or that's at least what we're here to dive into today and hope to uncover with a great panel of experts here to discuss the Twin Cities office market. So covering leasing, we have Brent Robertson, Managing Director of JLL and Market Lead on the agency leasing team in Minneapolis, where he has been for the past decade. I can't believe it's been that long.
I can't either.
Right? Time flies when you're having fun. Current leasing projects include the iconic IDS Center, Towers of West End, KBS's 60 South 6th, the new Gateway development, PwC Plaza, and T3 in the North Loop. Covering capital markets, we have Tom O'Brien. I don't know if we can pull Tom up on the screen for him to be able to say hello, but Tom is Executive Director at Cushman Wakefield with nearly 20 years experience. Tom has sold close to $3 billion worth of real estate, widely recognized as one of the top investment professionals in the industry. We are excited to have him with us today to share his market knowledge virtually. Hi, Tom. Thank you for joining us.
Yeah, happy to be here.
And our third panelist is Scott Peterson, Vice President of Hospitality and Office Development at United Properties. Scott joined UP in 2019, where he quickly made a noticeable impact on the company's Rbc Gateway project. Scott focuses on site acquisition, project underwriting, design, development, and construction. So we'll hear from all our panel of experts first on on where we've been, and where we are, and where we're going, and then do a deeper dive in the broader issues that have affected the office market from a development, capital markets, and leasing standpoint, and really just see what we can expect by reading the tea leaves. Brent, would you like to start by giving us a lay of the land and on leasing in the Twin Cities over the past 18 months?
Yeah, absolutely. So it's kind of an office broker's duty to do this. I did it about 10 years ago, and when Erin called me a couple months ago, I thought, you know, if there was ever a time I really wanted to do it, because things have been so strange over the last 18 months, it's this year. So Erin, thanks for having me do it.
Yeah, absolutely.
What I'd like to do is have a little fun. We were talking about just how things have changed. And usually you do a year in review. So it's the 2021 update. And I took the approach, and I think everybody did on the panel, of let's just look back March 2020 to today. Let's look at that 18-month period and see how have things changed, and really where are they today in November of 2021 moving forward. To do that, though, I want to go back to April of 2020. It's a 2-minute video of a office broker in, I think he's in Amsterdam. With Cushman
the
Wakefield.
Netherlands, yeah.
So I'm not going to comment. I'm going to play the video, and then we'll go from there.
Yeah.
So,
Okay, perfect. Here, you're in charge.
oh, I'm in charge. Okay.
Yeah.
Again, this is April.
We started the 6 Feet Office project with the ambition to get the world safer and sooner back at work. We believe that a safe and healthy workplace is at the center of what's next. We have developed the 6 Feet Office as part of our total workplace concept. Cushman and Wakefield can get companies operational as soon and cost efficient as possible. We would like to inspire organizations and people about a safe and healthy workplace, finding a better work-life balance, and becoming more engaged with the ambitions of your organization. We would also like to invite companies to join us develop the 6 Feet Office project further from a technology perspective, facilities, or just good ideas to make work better. Thank you for helping us move this forward. Together we're stronger.
The 6 Feet Office.
So raise your hand in this room if you've implemented the 6 Feet Office in your guys' office. Okay, we got 2, 3. So we did. We opened our offices, our JLL offices, June 15th, 2020. We put the, go clockwise, 6 feet. I can tell you today, it's all down. Everything's pretty much back to normal, other than a handful of unvaccinated who have to wear masks when they're walking around the office. So, but it's been tough. I mean, office has gotten, of all the sectors of real estate, has really struggled with the pandemic. And so, the people that know me, I'm optimistic by nature. So I tried to bring stats to this to just really paint a picture of where we are today and where we're going. So the first one here is this is a graph of just leasing volume by quarter. And as you can see, the precipitous drop off in 2020. But over the last 6 quarters, particularly previous quarter to this quarter, leasing volume has picked up. These are all national stats. A 7.8% increase in Q3 over Q2. And as you can see from the bar graph, the leasing, it's not shooting up. It's not a V recovery, but it is slowly, leasing volume is picking up across the country. The second thing, we've been losing occupancy at a rapid rate. This next graph, we still had negative 7.3 million square feet of net absorption across the country in Q3. But again, this stat shows you the last 4 quarters in particularly that office negative absorption is slowly creeping up towards 0, and hopefully over the next 2-3 quarters, particularly in January. I think a lot of companies are saying January or first quarter is when we're really going to start coming back. Our hope is that this flips and goes back to positive. Secondary growth markets, and I would call Minneapolis, St. Paul definitely a secondary market. I personally, being a homer, call it a growth market, and I think a lot of people would agree with me. The thing I want to point out is these markets nationally are recovering quicker. Why? And the big reason is you look at Minneapolis, St. Paul, you look at Austin, Texas, you look at Charlotte. Unlike the gateway cities in Chicago, there's not the reliance on the mass transit. So particularly in Chicago or the BART in San Francisco, it's just so many of the people that are working in the city every day rely on that system. And although we got a great light rail system and a great bus system, we don't have the high level of reliability on that system that the gateways and Chicago have. Mm-hmm. We'll talk a little about concession packages. That is the one thing that consistently across the country we've seen. As rates have, for the most part, held across the country, an increase in particularly free rent and tenant improvements, as the graphs here show. And again, this program will be sent out to everybody. It shows that those have risen over the last 6 quarters, but are now starting to dip a little bit just Q3 to Q2 of 2021. Term. So when the pandemic hit, everybody wanted to do the one-year deal, the 2-year deal. We had a tenant in one of our buildings who did a 1-year deal, and now that 1-year deal is up, and they want to do another 1-year deal. And we're not going to do another 1-year deal. We're going to talk about at least a 3 or 5-year deal. So the average term, again, as investors are building and they want that WALT when they go to exit, is growing. It's up to 7.7 years after a dip of around 5 years up to middle of 2020. The sublease story. So these are the national, and I don't know how well you guys can see the graph, so I'll just walk over here. But this is a graph that shows sublease volume that's been added to the market since the pandemic hit. So Minneapolis is right here. So that's a little over 3% of our total stock, and it's about 2.5 million square feet. We have added 1.7 million square feet of sublease product since the pandemic hit. But comparatively to some of our other markets, Minneapolis, as a percentage of the overall availability in the market, is holding really well. The big gorilla in the room is the bullseye downtown, 900,000 square feet. These stats do not reflect that because currently that market is not, or that space is not technically on the market. But that is the one thing I want to point out. It does skew the stats a little bit. And this is the one I love. So over the last 6 quarters, sublease product has been coming on the line every quarter. Q3 2021 nationally was the first quarter in 6 quarters where we actually had a decrease in the amount of sublease availability across the country. It was a combination not only of more companies taking those subleases and absorbing them, but a significant portion, up to 70%, were just companies saying, nope, I'm taking off the market, I'm moving back into their space. So as I look at signs of recovery for the office market, this is, to me, the biggest one that just says, you know what, we're headed the right direction. Effective rents. I mean, we all want high rates, but at the end of the day, it's what's the return on the deal. And again, for the first time in the last 6 quarters, NERs of all the deals JLL tracks nationally increased 2.5%. Now, they're still 13% below pre-pandemic levels, but again, another indicator that from a landlord perspective, the office market is returning. And deals that got done in the last 18 months. And the deals, a lot of deals got done. I can't talk about all of them today, but I just, people are wondering, like, Brent, are deals actually getting done downtown, in the suburbs? What's happening? They are. Frederickson and Byron signed a 180,000 square foot lease at 60 South 6th. Castle Lake, 45,000 square foot lease moving from Wells Fargo Center to the new Gateway project. EY, Erin did a deal with them for 35,000 square feet.
Yeah, moving in next week.
At Dayton's Flipgrid at Washington Square. And last week, we just got a deal completed with Jim Damiani for a full floor at IDS with Fulcrum. So deals are getting done downtown. And they're getting done in the suburbs as well. Help Systems and Agility moving to 1 Southwest Crossing. 2 Harbors, Radisson Hotel Group moving to 10 West End. Bright Health taking a big sublease at Normandale Lakes, and Prairie Care moving to Pentagon Park. Again, these are just 6, but I mean, DCM, 55,000 square feet moving from Best Buy to the block. I'm blanking Jimmy on the group, 25,000 square feet at 7700 France. Portico. So the market is replete with large chunky users signing lease deals, and these are not short-term deals. These are 7, 10, 15-year deals. So again, deals are happening in the market. And then here's this quick list, and again, I'll send this out when we complete the presentation. I do want to talk about flight to quality. So this is a trend we're seeing nationally. The graphic shows right now, it just shows you of the absorption, what percentage of the absorption that we're seeing across the country is buildings that were built in these different eras, so 60s, 70s, 80s, 90s. And you'll see the vast majority, the top of the line of the red absorption, is buildings that were built between 2015 and today. It's really a sign of flight to quality. And it's locally reflective. It's reflected in a lot of projects, but 3 in particular I want to talk about is 10 West End. So 10 West End, built by Ryan Companies and Excelsior Group, it delivered in March of this year, believe it or not. So in the middle of this pandemic, they've now totally spec. They didn't have a single tenant, 350,000 square foot building. They're now 60% occupied based on LOI and current activity. They project to be 80% plus stabilized by the spring. And this fall, they'll be looking at either refinancing or bringing it out for sale. and then looking at 20 West End. So talking to Tony and Pete Fitzgerald at Ryan Companies, they're very bullish on 20 West End. And these guys, these deals are getting done at the top of the market. These are 28 to 35 net rates. That we just haven't seen those rates, and that's in the middle of a pandemic. So it just shows that tenants are willing to pay up for the best building. I think in previous markets, it was always what buildings check the box, and then we'll take the lowest cost. Today, it's what buildings, what can I afford? I want to get the best building I can afford. And if you can afford 10 West End, the tenants are going there. Gateway is another example. It's opening in the spring of this year, and Scott will talk more about that project, but 97% leased when it will open its doors. There's 2 spaces left, 2 10,000 square foot vacancies, rates in the high 20s. Just a phenomenal project, which, again, I don't want to steal your thunder, Scotty, so I'll let you talk more about it. And then last week, Hines announced that they are going spec on the North Loop Green project, which will deliver another 350,000 square feet of office product to the North Loop market. Again, almost completely on spec. ESG has signed for 35,000 square feet, which is about 10% of the project. But Hines is seeing it nationally. And again, we're obviously seeing it locally, that going spec, and Fortune favors the bold. Ryan and Excelsior Group were bold. United Properties was bold. And now Hines is following suit and is going bold with pretty much a spec office development. And then before I pass it off to OB, just the 4 pillars as we kind of see at JLL of office, as we're all trying to, going back to that video we showed at the start, it's like, I commend that guy for, going out there and saying, hey, this is how we're going to live, this is how life's going to be. I think we're now finally getting some real clarity on what the office market is going to be moving forward. And these are the 4 pillars we keep talking about. Is number 1, office will remain the center of the work ecosystem. To create culture, to create collaboration, you need physical space. The second one, though, is that there's going to be a net impact on footprints, but it's going to be minor. Like, companies are going to go from 50,000 to 30,000. We're seeing it happen every day. What's also going to happen is there's going to be companies are going to add jobs, which is going to mean they're going to have to grow. They're also going to, their workplace strategy is going to change. They're going to need more space. So we think yes, that footprints are going to shrink, but it's going to be a minor intermediate impact on overall office space. The third pillar is a high importance on health and safety. What before became a luxury is now going to become demanded by employees. They're going to want an environment that is safe, that is healthy, both physically and mental health. 50% of office workers that are working from home during the pandemic have dealt with some sort of mental stress with the working from home in the pandemic. So there's going to be an elevated importance on health and safety. And lastly, the hybrid work, it's going to have a durable presence. It existed pre-pandemic, but it's going to be more. It's come to light more in the post-pandemic world. And certain jobs, they don't need to come in the office every day. Others, they do. And I think what we're going to see is more and more companies develop a workplace strategy that takes into account a portion, of their workforce working from a hybrid. So with that, pass it off to OB.
Thank you, Brent. Appreciate that. Tom, do we have you online?
I'm ready to go if you are. Yeah, I appreciate it.
Fantastic. Yeah.
But glad this worked out. I've heard it said as parents that the days are long, but the years go by quickly, and that's sort of what I feel like the situation we're in with the pandemic as well. You look at we're a year and a half into it. We've covered a ton of ground at this point. It seemed like we were all kind of on an endless Zoom call for a while, but a lot of things have happened. And so if there's just one thing that you take from my comments this morning, it's that, office products not going away. So I would echo a lot of what Robbie was saying. And we've seen investors and lenders and tenants that have leaned into it. We'll show some examples of that, but we expect there's a lot to come in 2022 that I think will be really positive for the office market. And there are a lot of signs as to why we see a number of investors getting back into office in a big way in this coming year. So over the next few minutes, we'll just go through, try to put some of this in context for what we saw over the last 18 months, and then I'll show some transactions that hopefully highlight some of those points. So if you want to go to that first slide, So if you recall, in early 2020, so in March and April and May, a lot of investors were trying to find distress. I mean, a number of people anticipated there'd be significant distress in the market. So we spent a lot of time closely monitoring collections at various projects. And the truth of the matter was there wasn't that much distress on that front. But at the same time, there was a lot of capital seeking safety and certainty. And so at that point, a number of investors really pushed on their allocation to multifamily and industrial. So we can go to that, and single tenant net credit lease deals. So if we look at this slide, there's a lot of detail on there, but basically let's just pay attention to the trends. So the bar graphs in total, that's total transaction volume for office, which is blue, industrial, which is orange, and multifamily, which is gray. And you'll see 2019, multifamily since 2019 has been up 26%, up 39% from 2018 numbers. Industrial has seen a big push, and again, this is nationally. And then office investment overall is down 27% since 2019. If we go to the next slide, this is Minneapolis. And so Minneapolis, a little more dramatic just on the office front, but keep in mind, just because our market is smaller, individual transactions tend to have a lot more impact on these stats. But, we're overall, transaction volume in office is down 91% from 2019. Well, let's go to the next slide. This is a breakdown. So this is all office transaction activity, but the blue representing CBD office sales and the orange suburban office sales. So 2018, 2019, those were roughly 50-50, and both of those really active years on the sale front. And then 2020 and 2021, obviously big drop off in CBD versus suburban, but that trend is going to change dramatically here, we believe, starting in early 22. So, and I will say too that we've seen a lot of suburban activity in the last couple of years. We've seen quite a bit of single-story office activity as well. So, there have been a number of transactions that have happened, and we've been really encouraged. On any of the projects that we've worked on, we've had a highly competitive bidding environment. So equity has shown up, the lenders have shown up, and so we've been encouraged. And heading into next year, we think there are a lot of signs that point to even better activity. So if we go to the next slide. So this is a little bit detailed, but the big takeaway here, the red line is net office absorption, and the black line is office employment. So historically, there's been an 82% correlation between these numbers. You see those lines track one another fairly well, but we have a big disconnect right now. The jobs are back, but we haven't seen that net absorption. But as Robbie talked about, we're starting to see some signs, be it, less sublease space, or, you start to look at some of the lease transactions that have happened that are pointing in the right direction. And so why don't we take a look? I won't be able to show you all the deals that happened in the last year and a half, but just a couple of key deals that demonstrate some of the themes that we've talked about. And note how many of these deals, on some of these buyers will show that they're new to Minneapolis. Roughly 70% of the transactions I'll show you will represent new capital to Minneapolis. And that's in keeping with really kind of what we've seen across the last year and a half. So this first deal is Thrivent's new headquarters building, downtown Minneapolis, closed in January of 21. This was a 20-year lease. They set their price at their cost, which was $500 a foot. had we just done a more traditional transaction, no doubt that number would have gone significantly higher than that. But this was, we had 30 initial offers in the first round. We had 4 rounds of bidding. The capital pursuing this deal was international, national, it was institutional, it was private, it was a real cross section of the capital profiles out, and understandable. I mean, Thrivent's an incredible company. There's a ton of security with a deal like this. Next slide. So the next is somewhat similar theme. So Equus sold earlier this summer, sold 3 of the 4 buildings in the Metro Point Office Park. These are 93% leased, majority anchored by Wells Fargo. Very aggressive debt on this transaction as well. But again, this was much more of a cash flow play focused on Wells Fargo. Next slide. The block. So this is a suburban project, light value add, 85% leased, but there's a 9-year weighted average lease term in place. And Hudson Advisors was rewarded, for the lease deals that they did. A couple of those deals were had been completed just prior to sale. So we might get into that on the Q&A a little bit, but we're definitely seeing investors appreciating longer lease terms at this stage in the game, and sellers getting rewarded for that. Next slide. The Swervo, so this is Ned Abdul's portfolio. This included 3 buildings, just under 80% leased, almost 400,000 feet. His new building is fantastic, did a great job on the renovation of the others. And again, this is new capital coming to Minneapolis. And we'll talk a little bit about, I think, how things feel in the CBD versus the suburbs, but I will say the North Loop feels really normal. And I think a lot of that has to do with the density of residential there. The streets are pretty active. It feels safe. There was a lot of outdoor dining, et cetera. And so the North Loop portion of the CBD certainly felt normal, and there was good activity there this summer. Next slide. So there were a few investors that played offense and went after more deeper value add deals. River Place would be a good example of that. Again, Crestlight has been in the market, but their equity, which is Harbert, they are new to the market. This was a pretty heavy lift, both from a base building standpoint, as well as some of the cosmetic repositioning, and they're having some pretty good success on the leasing front thus far. Next slide. Crest Ridge, again, new capital to Minneapolis. Larson bought this building vacant. This had been Syngenta's headquarters, single tenant. They're prepared to multi-tenant it, and proactively went in and started doing some work, and they've also had really good leasing success there. And last one, One Southwest Crossing. So Eagle Ridge Partners should be commended for the work that they've done. This was, a big, as any of you who've been in there, this was a big mid-'80s vintage full height atrium, and they've done a spectacular transformation of that space, and have really good leasing activity now as well. So we've seen a number of groups playing offense, while some people thought everyone was just hanging around in their pajamas, and they're going to get rewarded for that. With that, I'll turn it over to Scott.
Great, thanks, Tom.
Good morning. Scott Peterson, Vice President of Development for United Properties. My fellow panelists have done a great job giving a high-level market update here, so I'll be as concise and direct as I can. We're going to kind of highlight a couple of our key transactions, do a couple case studies on some developments we've done, discuss Rbc Gateway, which has obviously already been highlighted this morning, and we appreciate the endorsement on that project. Office market adjustments, some of the spec suites that we've developed on behalf of our development group and our investors, and then 2022 and beyond. So United Properties, we currently own, operate, and manage roughly 2 million square feet of Class A office, primarily in this market here. Roughly 1.4 million of that is made up of our stabilized assets. The other 600,000 is made up of our development assets, where we will typically stabilize and sell that. As you can see, we don't think we've experienced a dramatic shift in overall portfolio at all in the last 18 months. If we look at our downtown portfolio, we had one minor contraction, we had one minor expansion, and the same in our suburban portfolio, we had one expansion. So when you look at 25, 30,000 square feet across a 2 million square foot portfolio, we feel very confident in kind of the storm we just weathered. We've had no direct lease terminations due to kind of COVID, due to kind of 2020 to 2021. And occupancy remains strong across our portfolio at about mid-90s, 95%. So all of that kind of translates to us is there's just been a lot of noise. There's been a lot of noise in the market over the last 18 months when it comes to the office. There's been press releases, there's been articles, there's been all sorts of things said, the migration into the suburbs, migration out, what does the office stand for? And we firmly believe that the office is here to stay. Of course, key deals have been done, the target sublease and those sort of things, so I'm not devaluing that. But I think the biggest thing we've focused on is the back to office timeline. I think the back to office timeline has taken much longer than we were anticipating, and I think everyone would say that they've been wrong about COVID 4, 5, 6, 7 different times, right? It's just been a hard thing to really grasp and put a pulse on. So you have a longer back to office timeline, and then you have some landlords getting creative with 1, 2 year, 3 year options. And so I think what we thought was going to happen in 2020 and 2021 was just kind of people still feeling things out. I do think, a lot of the graphs that the gentleman shared ahead of me, we are going to recover and we are moving up, and I think there will be winners and losers inside of that portfolio here locally as we expand into 2022 here. So again, we've touched on it. There's a lot of tenant requests for reduced term lengths and increased sublease inventory on the market. Flexibility, I think flexibility is the one thing that is significant and is a permanent shift that's probably going to remain in the office industry for decades to come. Just kind of highlight on a couple case studies. One of our larger single tenants downtown, they committed to a 12-year term renewal in June 2022, right in the heart of COVID, right in the heart of kind of civil unrest. And that was a strong commitment that they made to our building. It's a strong commitment that they made to the downtown core, and I think the core is still relevant and will still flourish. In the suburban area, we did have one of our tenants there expand from 30,000 square feet to 63,000 square feet. Again, not a real big significant square footage on a portfolio standpoint, incredibly significant to the tenant, right? To double their size and to commit to another 10-year deal. So again, kind of just outliers that are positive inside of our portfolio over the last 18, 24 months. Centennial Lakes Office Park, which is kind of an iconic development for United Properties that we've done. That's 95% leased. We've had a couple leases that have turned over, and we've been able to backfill those pretty efficiently in the suburbs. So Rbc Gateway. This is a 5-year entitlement project. That's really the vision of Bill Catter and Rick McKelvey, and the support and the foresight of the Polad family to deliver a world-class amenity and an asset of this caliber to the city. We've been very successful to date. We've got great partners with Brent and JLL and US Bank. Really when you look at a 3-year construction schedule and what we just went through, we were very fortunate that construction was deemed essential work. And at that point of the project, our general contractor was also self-performing the concrete and steel that were both sourced here locally. And so when you look at COVID protocols trying to be rolled out, we were at the point in the project where it was really being held by just one company, McGuff, who was doing our self-performing the concrete. Over a 3-year time horizon, that's been pretty rough. We're probably within 1 or 2 weeks of our original schedule. So great execution by the team at Broad here on this project. We're excited to open. We're scheduled to do the office February of 2022. We'll then open the Four Seasons Hotel in June, and then we'll start closing condos thereafter. So when you look at timing, key design elements, new offerings, you look at the timing of when leases were executed. You look at when tenants were just starting to do test fits and how that impact of COVID came into play. And what we saw is that the same square footage that tenants were pursuing pre-COVID is the same square footage that tenants are still signed up for today. So I think that's a testament to test fitting it's not a square footage discussion. I think it's more of a layout, functionality, what do your employees truly need to deliver on. Key design elements, I think if your employee base has been out of the office for 18 months and you're trying to bring them back and you're just thinking you can open up the door and let the dust settle, I think that's going to be tough. I think it's going to be a tough sell to your employees to come back. We think we've delivered a best-in-class asset from amenities, from state-of-the-art technology, all within this vertically mixed-use building. And then new offering, we truly think kind of new always wins from a development standpoint and from kind of a transaction value. Looking at kind of Thrivent and Xcel Energy transactions that have been done, we feel very confident with our underwriting on this project. And again, we're excited to open it here in 2022. So just kind of touch on some spec suites. We did go out. We had vacancies pre-COVID, and we've gone out and added some square footage spec suites, anywhere between 4,000 square feet to 15,000 square feet. We've had success. We had one of them pre-leased pre-construction, one of them leased post-construction, and due to that momentum, we just recently finished another 3. Those deals are looking at anywhere between probably $18 to $21 square foot in rents, and those terms are anywhere between 12 months to 36 months. Build-out costs were probably around $45 to $50 a square foot. We're probably another $15 a square foot in furniture. And back to the comment earlier about flexibility, the technology is really flexible. I mean, it's a plug-and-play type environment that we're trying to cast a net to any potentials in the market. Just some other kind of comments here. We've had groups that have expanded in the middle of this to I believe somebody's comment about the North Loop. I mean, that culture is incredible in the North Loop. I mean, it's a sub-market inside the CBD 100%. So we have had groups kind of stay true to that office standpoint and growing that organization. So what's ahead? As we look at office rent as a percentage of payroll, it's a pretty small number, and so we think the office is here to stay. We think that's what drives a culture and generates the bottom line. If you don't have an office, I think you end up with a lot of almost consultants working for you, and they don't feel connected there. The time horizon of COVID-19, again, I've been wrong more times than I can count on COVID-19, and we go back to March, April, May. It was kind of 2020. The thought process: what is COVID? What's happening? And then you think about kind of June to September, it was like everyone's going bankrupt, every company's going bankrupt. I mean, you could not imagine the flights not flying and nobody parking in a parking deck. And then since that point, it's really been how do we get back to work safely? And we're still in that mindset. I truly think that, we thought that was a 90-day to 6-month deal, and I think it's an 18-month and onward type deal. So with that, I think there's been a shift in mindset. You first heard remote working, and then you heard hybrid, and then you heard flex, and we don't hear remote working that much anymore. I think it's truly going to come back to kind of this flex type standpoint. Build-to-suits, as a developer, we love build-to-suits. We love high credit build-to-suits. I do think the opportunity for build-to-suits moving forward are going to be based on an organization's ability to evaluate and determine what exactly they need for their new office of the future and what that path looks like. And I don't think until they get fully back in the office can they evaluate that. So I think there's a gap there, right? I think you need to be back in the office for 12 to 18 months to understand what that future looks like. You have to have probably a pretty aggressive board to understand what a new build-to-suit looks like. So I think that time horizon could be 18 months or so. If I go back and look at the roughly 1.3 million square feet of RFPs that were in the market in 2019, to my knowledge, none of those have come back to life. And I think part of that is we're still kind of in this little bit of a limbo area there. Spec, obviously Brent touched on a couple things. I do think you'll see some spec development in certain pockets. I do think for us, on our point of view from United Properties, we'd like to see negative absorption kind of stop before we start pursuing spec. Now, obviously, we've made some great progress, especially in Q3, to kind of attack the negative absorption. The market is not the economy. I mean, I think if there was ever a time where that was made true, it was in 2020 when you have, government lockdowns, businesses not open, people not traveling, people not eating out, nobody driving their cars, and yet you've got a stock market that's that's continuing to grow. I think that correlates to a lot of money. My second to last bullet point here, a lot of money on the sidelines for real estate. The K-shaped recovery is something we talk a lot about at our company, and if you're not aware of it, look it up. It's a pretty fascinating concept. And then just lastly, consumers and the economy. I think consumers are ready to go 0 to 100 miles per hour. They've got some pent-up demand, and I think the economy's trying to go 0 to 40. I think when you look at the labor shortage, I think when you look at the material shortage, when you look at lead times, I think that gap is going to continue here for a while. So with that, I think I'll turn it over, and we're going to go with a little bit more of an open format.
Awesome, great. Yeah, thank you, Scott. Appreciate it. Yeah, so much great information. I appreciate the perspective of all the panelists. And just to kind of dive a little bit deeper into some of the issues, we're here to talk about the overall office market in the Twin Cities. But last week, Minneapolis experienced one of the city's most historic elections. Jacob Fry was reelected as mayor. The ballot to go from city council leadership to executive mayor, legislative council structure passed 53 to 47. Some city council seats turned over to lean more moderate. Rent control passed 53 to 47. That's a topic for another panel, another day. But the amendment to dismantle the police force failed to pass 44 to 56. How will this impact the office market in Minneapolis? Brent, I'll shoot that to you first, and then Tom, if you're with us, I'd like you to weigh on that from a capital markets perspective too.
I mean, first and foremost, yeah, we were all holding our breath last Tuesday, and I was talking to Anna Koskinen this morning. I mean, it could have gone better, but it went really, really well. And both sides of the coin wanted reform, and they just disagreed on how to do it. And I think having the structure we have in place is only going to reinforce and get more and more users comfortable with downtown Minneapolis. It's only been 10 days, so we're still gathering data points. And so this is a little bit more art than science. But like yesterday, we had 6 showings in downtown Minneapolis, and we started our Monday meeting, looking at our schedule and say, okay, who's got this showing at this building? And okay, yeah, but then I'll run over and do this one. And I can't remember the last time we've had that. So again, it's one day in something that's happened and just occurred 10 days ago. But I'm curious of what Tom thinks. But I believe that the way that vote went and the way downtown just continues to gain more and more employees coming back. IDS there's 1,600 people a day. 60% of the normal workforce are coming in. So I'm a believer, but let's see what happens when the big corporate users come downtown in January.
Yeah.
100% agree with what Brent is saying. I think a collective sigh of relief from most of the investors and the lenders, just seeing that the uncertainty of a Department of Public Safety that wasn't really defined. I just don't think was going to give them the confidence that the type of reforms that need to happen would be able to happen. And so, I 100% agree with that. I think from an investor and lender standpoint, they feel like the tools are there now, especially with a stronger mayor as well, that reform may be able to happen more quickly, and there's some infrastructure to do it in.
That's really encouraging to hear. The election seemed to be, at least for Minneapolis, the last of a lot of hurdles, like COVID and the Delta variant and civil unrest. And so, Scott, you kind of touched on it, said, 18 months and onward, we kind of expecting employees to fully be back in the office. But how are people getting back? What are employers' plans to the extent that you know about them? Getting back to the office, and how will that impact not only the downtown core, but also the suburbs? Are we back more in full force in the suburbs? And really, what's employee sentiment to the extent that we have any insight on that versus companies wanting employees back?
Is that directed to me?
You can start us off.
Sure. So there's a lot in that statement. I'll do my best to dissect it. I think the path of the employee has shifted, right? And I think that's why I think you saw earlier occupancy in the suburbs, right? I think employees were ready to come back, drive, park in a 3-acre parking lot, walk into a door that maybe was just their company door, not a heavy shared amenities. I mean, I think people mentally, emotionally were prepared for that sooner than they were, take mass transit downtown, walk through a skyway, get into an elevator that goes up 35 floors, shared amenities, right? So I think we've come a long ways to Brent's point, if you look at how fast people responded to taking off masks, I mean, I think we've come back over some of those hurdles as well. So I do think path of employee is something that's new to consider. I also think two things. One, we all had the blessing of doing this work from home experiment together. And so that drove some sort of grace period or understanding with people's dogs barking in the backyards or this or that. I think as you go to a more 2-3 years down the road, I think there's going to be less tolerance for some of that. I do. I still think people are going to want people in the office. Deals are still going to happen in the office. Transactions are still going to happen in the office. So I do believe that. I also think you're going to see, and I think you're starting to see it a little bit on kind of the corporate travel side, which is, the minute a company loses a client because they failed to get on a plane and go visit them in person, or the minute that they tried to do a 4-person remote presentation that had a TI problem or had an issue, I mean, the minute I think a company loses a client because of that, there'll be a stronger push for certain dynamics of business to always be done in the office.
Okay, so you sound pretty bullish on it. So if you had to put all of your chips in one Twin Cities market, what would it be as it relates to future development? If you're thinking about office development and everything that you just said and the confidence with which you said it, and you're saying we're going spec here, where would that be?
Well, we think we've done really well with this in downtown with Gateway, right? So, I would say we wouldn't be opposed to looking at another deal in downtown based on the success we've had there. I would hope it's not as complicated. And then there are sub-markets. I mean, we're chasing opportunities in the western suburbs. We're chasing opportunities in the south area that we do think have potential. So the only caveat I would throw in there is North Loop. If you were in North Loop at all in the summer of 2020, it was completely different than Nicollet Avenue. It's completely different than IDS. I mean, the North Loop is I think has probably been the neighborhood submarket that's performed the best out of all this. So I know that's a little cagey, but I would say we're still chasing deals kind of in all major markets.
Okay.
I won't be cagey. It's West End and North Loop. Those are the two. I mean, full disclosure, I mean, we're partnering with Hines as the leasing agents on North Loop Green. But the North Loop in particular, that neighborhood is the amenity. And you look at markets across the country like Dumbo in New York and Fulton Market in Chicago and now Rhino in Denver, these neighborhoods that have an advantage because the neighborhood itself is the amenity. And I look at North Loop as being that.
As being that. Okay. So that's interesting about that. What are your thoughts, Brent, on the Dayton's project? So the Dayton's project grand opening is next week, opening 94% vacant, with EY moving into, as we said, 35,000 square feet, and the department's retail opening on the first and second floor lighting Nicollet. That, coupled with City Center right next door, with the Target sublease giving back 33% of its overall space, nearly 1 million square feet of hitting the downtown. I mean, between the two buildings, it's just shy of 2 million square feet hitting the downtown market all at once, at opposite ends of the rate spectrum. Right? You've got as low as you can go and as high as you can go, but they're right next to each other. They're right in the core of downtown. What do you see the impacts of that being? Yeah,
so I'll take one at a time. First of all, for those who haven't toured the Dayton's project, it's amazing. Like 601W with Telos and Transwestern have done a fantastic job. And I think Monday's the grand opening.
Yeah.
So I'll be there. I'll be there.
Official grand opening the 18th. The VIP grand opening is there.
That kind of investment in the core of our city is fantastic. And so its timing is unfortunate, and nobody could have predicted COVID, so when that delivered, but it's a big chunk of space, but it's a beautiful renovation, and it's just a matter of time. If you look at what 601W did with the post office in Chicago, I toured that 3 weeks ago, and they got 25 tenants. They're 94% occupied, and the vast majority of that was done during COVID in a
building that's 2 million square feet.
In a location that is like on the edge. It's not in Fulton Market. It's not in the West Loop. It's like on the edge of Chicago, and they're crushing it. So I do believe that it's just going to take time. We got to get the market back, and the Dayton's project will fill up. The the target sublease is really, that's changing every day. Just now they're starting to get tenants to look at that. Target hasn't come back yet, so I think that needs to be pointed out. Like, Target's trying this flex. Hey, managers, you decide how often you come in. You can go up to Brooklyn Park. You can come to the headquarters. They'll tell you, like, we still, we're implementing this. Is changing daily. So I think I don't think that they're going to go back and backfill the 900,000 square feet. But the user market hasn't told us exactly what they think of that product yet.
Right.
And now we're getting into my personal, as I read the tea leaves, I think that users, like I said earlier, are just going to gravitate to paying them as much as they can to get the best building they can. And taking cheap sublease space is not going to get tenants excited to come back to the office.
Agree.
Yeah. Yeah, there was an article on flight to quality in the Wall Street Journal last Wednesday, and the success of local new developments, Gateway downtown and 10 West End seem to exemplify this. Tom, you and I had talked about this kind of a little bit more. What else do we need to know about flight to quality, and maybe how could we advise owners who maybe don't have the biggest and best and newest building to be able to tap into this trend, to not be left behind?
Yeah, and I think Scott had some stats about the age of projects. And so, yes, newer, shinier projects, newer design can oftentimes have an advantage. But I think what we're talking about are really differentiated projects. So I think West End Office Park is a great example of that. So it's not the newest. From the exterior, it's not going to blow your doors off, but from the interior, from this holistic tenant experience, I think they did a fantastic job with that project. So I think you're seeing a project like a One Southwest Crossing or some others that have really had some transformational improvements in those buildings. They've differentiated them from their competitive set. So that's where I think investors, we have so many conversations with investors who say, look, we just don't want to buy commodity office. And I think the most successful projects have certainly gone beyond commodity, and investors, lenders, new owners have been paid for it.
Yeah, good point. We'll get to audience Q&A here in a second, so if any of you have ideas percolating, get your questions ready. But so just, question, I mean, it seems like we're asking this all the time, but suburbs versus downtown, how do the suburbs compare to the core? Will there be a reverse trend in migration? We mentioned Portico is going to be moving out to the suburbs. I think that's the biggest exit out of downtown that we know of so far. But there have been a handful of others. What does that really look like? I think we've established that downtown is not going away, that there is still a place for that. But will it shift? And how have the suburbs shifted as a result of the past 18 months?
So even before the pandemic, there's always been an ebb and flow of tenants moving from the suburbs and downtown. And I would say leading up to the pandemic, that was tilted with suburban companies moving to the core, whether it be the North Loop or downtown. That stopped in March of 2020. Totally stopped. I think going forward, we didn't see, other than that one Portico, there was, call it 3,000, 5,000. There was some wealth management firms, some private equity companies that left downtown and went to downtown Wayzata or the West End. But it wasn't like this mass exodus at all. And now that we're 18 months into this, I think if I was going to say one comment about it, it's if you were a suburban firm before, you're still a suburban firm. And what attracts you about being in the suburbs still attracts you to be there. If you're a downtown firm and what the benefits of being downtown, you haven't changed. That's what I'm seeing. I'm not seeing these companies now that we can kind of see the light at the end of the tunnel coming out of this. They're not changing their culture. Their culture hasn't changed because of the pandemic. Does that make sense?
Mm-hmm. Yeah, Scott, Tom, I don't know if you have any additional.
No. I think Brent said it perfectly. I think at the end of the day, it's a net zero. I think you'll see some in and out, back and forth, but I do think there are people that are just committed to downtown and people that are committed to suburbs. And again, we put it as, there's just been a lot of noise on this topic, and very little action. I also think if you're a corporate real estate person and you have a lease expiring, with the amount of sublease on and the amount of vacancy, you're going to go kick the tires on as many deals as you can, and that includes suburb and downtown. So I think at the end of the day, there'll be some, flows in and out, but I think it'll kind of be a net zero.
Add to that.
Okay, well, I think that's that. Does anyone in the audience have any questions? Is there any? Yes.
Sean.
Let me grab you the microphone so that our folks at home can hear you.
Thanks. Just talk about tenant amenities. Maybe compare them to prior COVID and what was scrambled in the COVID area, and what are we seeing now, or has anything changed?
Brent?
Yeah, the focus we are seeing, the conference and the training center, you have to have it.
I would say that you have to have it with the technology to be able to bring Tom in last minute in presentations like this. You have to. We've developed so many conference centers and so many buildings, and I feel like we're stepping back into them, and they're now almost obsolete because you don't have the camera set up in the right place. You maybe don't have a camera at all, and you don't have the right lighting or microphones throughout the space. So if you're having a Zoom meeting with a handful of people, or 10 or 20 or 30 people live in the room, the technology isn't necessarily there existing today to accommodate this, the type of technology-focused meetings that we are now all having. Mm-hmm. But go on.
No, I totally agree with that. And the technology, we need to catch up. I keep saying the war room is going to replace the boardroom. You don't have to have a 12-person boardroom to have a meeting. You can do that on Zoom. But to have a war room to collaborate and solve a solution, I think you're going to see a pivot. So you're going to see a pivot, Sean. The amenities going more towards the war room and the technology that Erin talked about. But also just the tenant, I'm calling it the tenant lounge, the experience, that's being elevated. I toured 333 North Green, Sterling Bay's new headquarters in Fulton Bay, and they got a whole floor, and they've got it's like a 15-foot ceiling, and it's got every social amenity you could want. So I think you're going to see more of that, and I think you're going to see the percentage of a total building's footprint be dedicated to amenities like that. Whereas before it was maybe 2 to 3%, I think we're going to see upwards of 10% of some buildings.
And also flexibility. I mean, at one point, you had brought up that flexibility is the new amenity.
Flexibility is the new amenity, and it's on a number of levels. It's the new amenity for employees, the flexibility to come in when I want. It's the new amenity when you're negotiating terms. Flexibility. It used to be, hey, Brent, I got a $80 TI. Can I use $5 for FF&E and free rent? You're seeing more flexibility with that. It's contraction. It's landlords being flexible with the lease terms. And then also the space. Like we're looking at one of our buildings, we're 60 South 6. We're going to build out spec suites, but you can't lease it for more than 3 months or 6 months. So the idea being like, hey, with Fredericks and Byron moving in, we talked to them about that. They're like, great, if we have a big case and we just need to, and we got to bring in some people and resources, we can just lease that for 3 months or 6 months.
Love it.
Again, flexibility, I think, is going to be the new amenity.
Yes, in the back.
Yeah, what are the lenders saying? What's going on in the office market for debt? And I don't know if Obi wants to weigh in on that as well. So.
Yeah.
Obi, did you hear that?
Pardon me?
Was that
Oh, yeah.
Colzer was asking about the lenders and the debt on the office product.
And how they're thinking about it.
I think I mentioned on all the deals that we've had, the lenders have shown up. The terms have been great. Some of the deals we profiled were lighter value add, much more focus on cash flow, whereas some were a deeper value add. There's still a lot of debt fund money out. It's still really inexpensive relative to historic cost of capital. So, they're picking their spots, certainly. As you know, Mark, industrial's at the top of the food chain right now for a lot of investors and lenders, as is multifamily. But I do think there's going to be, again, more focus on office as we get into next year and the following. I just think a little more clarity as we're starting to see with the product type and how tenants are going to use space, and some of the absorption will give them some comfort. There'll be new allocations of debt in January, and some of that certainly is going to be focused on office.
Thank you. Was there another question right up front here?
He just asked it. So
Oh, you had the same. You had the same question. Damiani.
So you mentioned a flight to quality, and a lot of these buildings have had great amenities over the last 5 years or so that have been developed. Erin, you talked about occupancy downtowns, maybe 25, 30%, suburbs, maybe 5, 10% higher than that. You go to a concert or a sporting event or a happening bar, and they're packed with the same people that don't feel comfortable coming to the office. How do you fix that?
It's all about the experience, right? I mean, I think you hit the nail on the head there, Jim. I mean, I'll see what the panelists have to say, but it's all like the concerts are packed because it's an exciting experience where they are engaged in something that inspires them, right? And the office shouldn't be any different. I mean, that is the place where we are meant to co-create, where we are meant to like dive into our purpose of what it is we are meant to contribute in this world. And so rather than seeing it as like a slave labor type of thing where it's like you're chained to your desk and you're under these fluorescent lights and in these boring gray cubes, make it exciting as possible, like going to a concert. Give employees that sense of increased inspiration when they walk through the door so that they feel this heightened level of consciousness when they walk in and they feel like they're operating at their highest selves and they have everything. They've got the cool people, they've got the food, they've got the drinks, they've got this whole environment that inspires them in such a way that they can just sit down and just rock out whatever it is that they need to do. And I think landlords and investors who are playing offense really well have done a great job setting that base for tenants that, but they can only take it so far, right? But it's the lobby lounges, it's the amenities, but I think companies are going to have to take the office to the next level.
Yeah, I don't disagree. I think the one thing is it's almost a retraining of the workforce and the employee base for what you do in the office now. So, we're on a flex schedule at United Properties. When I'm in the office, I'm not in my office doing emails like you used to be, right? I mean, we're committed to the office, and when we're in the office, we're in, to Brent's point, war rooms. We're in 2-3 hour meeting, collaboration, or you've got an Excel spreadsheet up and you're working through a deal or a pro forma, right? That's what we're using our office for, and I think that creates a level of excitement and energy and connectivity than just, I got to go in the office, open up my computer, and work through emails for the next 8 hours and move paper back and forth. And so I do think as people end up with flex positions, they're going to understand that when they're in that office is when they're engaging, and those emails can wait till the next day. And I think that's, it sounds like a small shift. I think it's a massive shift to correlate over to an entire employee base.
What do you think, Brent?
Labor's tight, Jim. So if that's going to change, and when that changes, so right now the employee that wants to work from home is empowered because guess what? If I leave, you're going to have a heck of a time replacing me. Eventually, that'll switch. So that's my first comment. And the second comment I would say is over time, you can't, and I've been saying this from the start, the senior attorney at ABC law firm can't mentor the associate when he's in his condo in Vail, okay? So the president of that law firm over time is like, dude, you're looking at 5 years retirement. What's your succession plan? And the young workforce doesn't want to work from home. They don't want to work from their 400 square foot condo in the North Loop. They'd rather walk to the Nordic or, T3 and work in that. And those folks are going to get tired of this. So I think those are the two elements that are causing what you pointed out. What bothers me as much as it bothers you, of like, okay, everybody's going to this concert and they're jam-packed at First Ave or Target Center, but they can't come in the office.
Good question. Anything else?
Mary?
Any other?
Do you have a question, Mary?
questions?
I can shout it. I'm curious, maybe this is a question for Tom. So much money to spend on space, extra space, and buildings downtown that have had difficulty trading or not trading at a high enough price. Is that correlated? Is it because the owners need to use that money and not rent are reflecting all the money that's been spent?
Okay, I'm not sure that Tom is going to be able to hear the question that Mary just asked, but
Or
if
anyone on the panel, too.
Sure, sure. Can you just hand her the microphone? There was a rather in-depth question. Can you ask it again, Mary?
Okay, so so many buildings in the CBD have spent a ton of money on new amenities, upgrading their spaces, and a lot of money on spec suites. And the net rents aren't necessarily going up to reflect that increase in capital costs. We've had a lot of buildings in the CBD go on the market in the last couple of years, but they haven't traded. And I'm wondering if it's because the prices haven't been high enough to recoup those capital costs, or what do you think is going on that some of those CBD buildings have not been able to trade in the last couple of years?
Yeah, that's a good question. I think if we look back on 2018, 2019, there weren't necessarily a lot that were taken to market in 2020 or even 2021 down in the core. But you had very healthy landlords as well. And so for a number of those groups, if they didn't get the pricing they wanted, which may have been, a lofty expectation, they didn't need to sell. And again, the debt has covered a lot of shortcomings if there are on some of these projects. So we haven't seen desperation. We haven't seen sellers just saying we just have to get whatever we can get at this point in time. So I think that's part of what you've seen downtown. I would also say that we get the opportunity of looking under the hood of a lot of buildings, and boy, I would say on most of the deals that we're seeing right now, it feels like a lot of the metrics of the lease deals are somewhat similar to 2019, and we've talked about some of the examples where you can really push rate in those differentiated buildings, and that gap is starting to widen. So we do expect that we'll see quite a bit of activity downtown in 2022.
Nice, thanks, Tom. I think we'll wrap it up here, and we didn't plan for this, but I'd like to do just a lightning round. If our panelists could just say one word or 3 words about how they feel about 2022, what would it be?
Optimistic.
Scott?
Growth.
Tom?
Back to work.
All right, I like it. So that's it. Optimistic, growth, and back to work. That's your outlook for 2022. Thank you all for coming today. It was so good to see everybody, and we'll be sending out this. But if you have any questions, feel free to reach out to any one of us.